Good day, everyone. My name is Ron Nolasco from International Trade Council. Before we start our educational session for today, if anyone from the audience can hear me, can you please type in yes on the chat box? And if you can see the PowerPoint presentation, just to make sure that it's working. All right, thank you. All right, perfect. Thank you. So, our webinar for today, the topic is alternative ways to finance trades or projects with a low credit rating. Our speaker for today, Christoph Schwartzig, Managing Director of Value Creation Alternative. Also, Mario Buriek, CEO and founder of Fides Corp. Today's focus grasps the significance of financial instruments and their intended purpose, acquire the skills to effectively monetize financial instruments, identify keywords essential to the verbiage of enhancing the value of financial instruments, familiarize oneself with the process of leasing financial instruments, master the art of establishing funds to secure capital and cover initial cost, gain insights into the structured framework of regulated funds, and discover optimal corporate structures and aid in tax saving. Now, let's hear directly from our esteemed speakers who will elaborate the topic. Please join me in welcoming Christoph Schwartzig and Mario Buriek. Go ahead, sir.
Thank you, Ron, for the introduction. During this webinar, we are going to talk about how to raise funding for trades and projects, although you may have a low credit rating. We will focus on the monetization of financial instruments, the establishment of regulated funds, and we will also touch upon securitization. So, with no further ado, let's focus on the challenge. You should all be familiar with the challenge when you're dealing with import-export transactions. Typically, the buyer is not willing to bear the risk for the importation of goods, whereas the seller needs upfront money to prepare for the shipment. So the question is, how can the seller access capital when buyers only pay upon reception of the goods? In this presentation, I will talk mainly about trades, but the same concepts can apply to project finance. When companies need to raise money for trades or project finance, they typically look at traditional sources of funding. Traders in emerging countries tend to focus or rely a lot on government aids coming from the like of the World Bank or the International Monetary Fund. But I have listed here other sources of funding like private equity investors, venture capitalists. We also have some companies that may try to raise money through exchanges going for an IPO or a D-SPAC. A D-SPAC is a special purpose acquisition company. Larger corporations can eventually issue corporate bonds. The question is, what if you are a small entity with a weak balance sheet and all the traditional sources of funding say no? During this webinar, we're going to focus mainly on 3 out of the 5 alternative ways of funding listed on this page. We will look at monetizing financial instruments. Those instruments are typically issued by the buyers. They could be bank guarantees, standby letter of credits, or documentary letters of credits. In some instances, we can deal with import-export credit guarantees issued by import-export credit agencies, the like of Sinosure in China or CESE in Spain. We will also talk about establishing funds, which gives us access to other investor profiles. And finally, we will touch upon securitization. Unfortunately, we won't have time to drill down into credit enhancements or emerging solutions leveraging blockchains like initial coin offerings, security token offerings, or non-fungible tokens. We won't either have time to talk about value creation alternatives, fifth way of raising money. We call it an IPO spin-off. The procedure is somehow similar to a de-SPAC and involves teaming up with a company already listed on an exchange. So let's start with the financial instruments. Before talking about the monetization, we need to understand that those instruments were initially designed for a different purpose. The purpose was to provide assurance and financial security to the parties when placing risky purchase orders. The type of financial instruments depends on the scope and the procedure of the transaction. A bank guarantee offers the broadest scope and covers the widest range of situations. SBLCs are used as a security to protect sellers for various types of transactions. DLCs cover the narrowest scope and ensure payments upon the presentation of specific documents. So when we receive requests such as, do you offer bank guarantees? This is far too generic. To come up with a response, we need to have a much deeper understanding of the scope and the purpose of the financial instruments. Here is an example, the simplest way to use financial guarantees and the reason why they have been designed in the first place. You have a buyer and a seller. They both want to deal together, but want to mitigate their respective risk. Usually there is a lack of trust between both. Therefore, they're going to involve their respective banks. The buyer will request an SBLC to the issuing bank that in turn will communicate to the seller's advising bank. In case of payment default by the buyer, the seller will be paid by his advising bank, whereas in case of non-delivery of the goods, the buyer will not have to pay. There is a hiatus between the time when the buyer places the order and the time when the goods are received and the payment is made. So how can the seller monetize his financial instrument upfront given this hiatus? Here is an example of the verbiage of a bank guarantee. I'm going to skip this quickly because this webinar is recorded and you can have access to the text by looking at the records. It is important, nonetheless, to understand that every bank has its own verbiage, and the differences between the verbiages is a source of confusion even between the bankers. For a guarantee to be monetizable, you need to make sure that it is transferable. Otherwise, the lender will not be able to use it as a collateral for his own sake. You will prefer to see the mention that the guarantee is with full bank guarantee, because this way you're transferring the risk from the company to the bank. And it's easier for a lender to assess the bank's risk because a bank is a regulated entity and there is more information available. Make sure that you understand the governing rules, because those rules will define the scope of the guarantee and the procedure to follow to enforce it. Just by changing one rule for another, you may transform a bank guarantee into a standby letter of credit. Make sure that you're dealing with banks with good credit rating, because unfortunately, dodgy banks will probably not be as cautious as reputable banks. And they may let issuers issue several guarantees backed by the same capital. Let's imagine that you have 10 million in cash sitting on your bank account. nothing actually stops you from issuing several SBLCs against the same amount of cash. So in case of default, the first one might be served, leaving the followers without compensation. We have brokers who come and boast that they have cash-backed guarantees. In reality, it is not so relevant because nothing stops the owner from withdrawing the cash. Reputable banks will put an administrative lock on the cash and will not allow the issuance of multiple instruments. Non-rated or dodgy banks may not. Make sure that the verbiage will be accepted by the lender's bank. Here is an example of a DLC that was not accepted. To tell a long story short, the buyer was so concerned with his risk that he basically transcribed most of the content of the import-export agreement into the DLC. Now, bankers are financiers. They're not traders. And they don't want to deal with all the nitty-gritty details of checking volumes and the quality of the goods. They just want to know if the contract has been fulfilled, yes or no. So keep it simple and do not request in your DLC documents that cannot be provided at the time of the issuance. Otherwise, that will automatically invalidate the DLC as a potential collateral. Here are some key takeaways. Although not their initial objective, financial instruments can be used as collaterals to secure a loan. They can be used for trade finance, credit enhancement, and project finance. However, every bank has its own verbiage, and the devil is in the details. So make sure that you get the wording right. You also need to bear in mind that those transactions can become extremely complicated very quickly, especially when the bankers do not know each other or do not share the same communication system. You may have to go through a correspondent bank and issue counter guarantees. Make sure that you are dealing with a bank which is reputable enough to have access to a SWIFT system. By the way, Russian banks no longer have access to SWIFT. If you are dealing with Islamic countries, interest-bearing instruments are not compliant with the Sharia law. We had a client in India, and the Indian banker was expecting a phone call. This is just not going to happen. Banks do not communicate via emails or phone calls. We receive multiple inquiries about the cost of issuing bank guarantees. The good news is that when you have a good enough balance sheet, it is relatively cheap to issue a financial guarantee. As in the example here, we're talking about hundreds of dollars or maybe a few $1,000s. Now, what happens if you do not have enough assets on your balance sheet to back the financial instrument? Well, the banker will ask you to deposit in cash an amount similar or even greater than the face value of the instrument to cover both the default and the cost of processing the claim. So let's imagine that you want a 10 million bank guarantee. They will ask you to deposit 11 million in cash. So obviously, this is not in your interest because you want the bank guarantee in the first place to get a loan. If you had the 11 million in cash, you would not need the bank guarantee. So what do? One way to work around this issue is to lease a financial instrument. In that case, the cost will depend mainly on the quality of the guarantee. If it's a full bank guarantee from a top-tier bank, it's going to be more expensive. If it's not a full bank guarantee, it will depend on the quality of the applicants. It all depends on the applicant's risk appetite, the market conditions, and then, of course, the competition. If you want the financial instrument as a collateral for a loan, make sure that the verbiage of the instrument will meet the lender's requirements. Otherwise, you're going to pay for a financial instrument that will not be monetizable, and it's going to be basically a loss. So there is a pretty high risk. And here is the bad news. Most lenders will wait until they see the financial instruments before making any commitments. So you will never be certain at 100% of success. Usually you deal with a bank's representative, and the bank representative might be very optimistic, but then it goes to the compliance department, and the compliance departments, may reject the proposal. Here we have a procedure from one of our VCS supplier to lease an SBLC. So you can see for a SBLC between 5 million to 20 million, I think on top of my head, this was coming from HSBC, AAA bank, there is a cost of 7%. The costs tend to be between 7% and 9%. You also need to add to that cost the brokerage fees. So for a 10 million SBLC, you will need to have at least 700,000 euros more the brokerage fees. Usually people come to us and they don't want to pay anything upfront. And look, it is completely illusory to believe that whatever instrument you're going to purchase can be purchased using the proceeds from its monetization. It's as if you were dealing with a real estate developer, asking him to build you a house and propose him to pay from the rent that you will get once the house is built. It's just not happening. So do not waste your time. This is not a straight loan. Issuing financial instruments cost money, period. Whoever is going to issue the instrument in your name wants to be protected. They want to be paid for the risk that you do not want to bear. So what do you do if you do not have the 700,000 that I just talked about before, but you still want this 10 million loan? The only way that you can get those 700,000 is to team up with one of several partners. You can find a partner that will put up the 700,000 as a lump sum. It could be a large company you can JV with. You can find some credit enhancers. Some funds are providing credit enhancements. You also have a few risk-taking investors looking for high yield. They will lend you the 700,000, but given the risk, they will ask you for a very high return, maybe 2 to 3 times the investment within a month. Some brokers refer to those investments as private placement programs or PPPs. You can also look for multiple smaller investors and do some sort of crowdfunding. We recommend establishing a regulated fund for that purpose. Regulated funds open doors on institutional investors, and you reach a different type of investors profiles. And within the institutional world, this is where the big money sits. So now I'm going to give the floor to Mario, who is going to talk more about regulated funds. So Mario,
thank you, Christoph. Thank you, Christoph. So now we shall be discussing investment funds and securitization, which, as Christoph has explained, are the regulated part, the licensed and the regulated part of how financing can be raised. When we speak of investment funds, there are various considerations to take into account. First of all, it depends on the size of the issue. So if the entity raising the financing is targeting, for example, a big chunk of investors, jurisdictions like Luxembourg will come to mind. If the issue is going to be financial instruments, then again, Luxembourg will be the entity, the country to look for. When it comes to venture capital or projects, then countries like Malta or Ireland would be suitable countries as well to issue such investment funds. From a legal perspective, again, depending on the jurisdiction in question, there are various forms which the entity can take, this including open-ended funds, closed-ended funds, or a combination of both. Regarding the considerations, a number of considerations shall be taken into account. These including the type of investors which you are going to target for example, retail versus institutional clients. If there are institutional clients, that is the investors which you are going to target from an investor point of view, then my suggestion as well would be a discussion with such institutional investors to see their preference in terms of fund. For example, there might be institutional investors who will ask you to have an open-ended fund. There are others who will ask you to have a closed-ended fund. So depending on the institutional investor in question, it will be good that you talk as well before launching the fund to these institutional investors which will be joining into the fund. Regarding investment funds, there are principally three types of investor funds. There is the so-called UCITS, and the UCITS are usually for smaller investors, and the underlying assets will be quoted instruments, and that is not the topic for today. And then there are two other types, the alternative investment funds, and there are various nomenclatures how they are called. Some countries call them professional investor funds, others call them sophisticated investor funds. In case of venture capital or capital to put into projects, we are looking at the alternative space, so alternative investment funds, and some of them can be marketed in other jurisdictions. So let's say the promoter launch a fund in Malta. If it is an alternative investment fund, that fund can be as well marketed into other European countries as well. So there is the so-called passporting right from one jurisdiction to the other. If it is professional investor funds or sophisticated investor funds, those type of funds have a limited marketing element. So you can sell the product, sell the investment fund based on reverse solicitation. So it needs to be the investor coming to you rather than you going to the investor, like in the alternative investment funds hemisphere. So these are considerations which, when our clients come to us, we guide them through the type of fund, we guide them through the jurisdiction which they need to go to, etc. So from the next slide. So regarding the users, as I was explaining as well, there are various users to investor funds. So you can look at the fund from different angles. Usually venture capital funds or alternative investment funds or professional investor funds, the clients will be family businesses, property company, venture capital companies. It can be as well blockchain entities, and the instruments which can be issued will be in the form of shares, and the form of shares will be called units into the fund. So essentially what will happen is that there is a pooling of investors. Those investors will be pooling the money into the fund. Those investors can be retail, institutional, professional, corporate, etc. The money will be put into the fund. There will be a so-called asset manager, and that asset manager, the role of the asset manager is to manage the funds accordingly. There will be a offering documentation of the fund, which will clarify where the fund can be invested, and then the role of the asset manager will be to invest the proceeds of the fund into the different ventures. Other parties will be obviously custodian and the manager, and again here it all depends on what is the objective of the fund. If the objective is to have a fund at the lowest possible cost, then the alternative funds are not the most economical to do. So we opt usually for professional investor funds. Jurisdiction is again important. So just to give a comparison, if a fund is done in smaller countries like Malta, the cost of doing such a fund and managing that fund will be more or less 1/2 or 1/3 of a similar fund done in larger jurisdictions like Luxembourg. From a fiscal perspective, there are a number of advantages when you have a fund. The income or capital gain of an investment fund from an investor perspective, that is, when the investor take back the profits or take back part of it as income, that income is not subject to tax in the home country of the fund in question. And from a shareholder's perspective, again, there is no similar tax. Another main advantage of a fund is that it can be as well listed on a stock exchange, on a formal stock exchange, or on a price vendor. We call them price vendors like Bloomberg, Telecourse, Reuters. So, and that will allow the fund as well to be more visible in the eyes of other investors. And regarding the structure, this is a high-level diagram of the typical structure which we have. It seems complicated in terms of structure, but it is not. And the main advantage of having this structure is that you give more transparency to the investors. And when investors see transparency, they trust more the entity in question, and there is a more probability, there is more chance for investors to join into the investment fund. So the composition is mainly based on three main elements. There is a board of directors composed usually of 3 directors, and each regulator will have its own fit and proper assessment of how the directors should fit into the board. But essentially, the board of directors will be the governing body and the ultimate responsible body of the fund in question. There is as well an important element, which is the investment manager, and again, depending on the jurisdiction and as well the type of fund, usually there will be an accompanying as well investment committee. So there will be one person acting as the manager and usually 2 other members acting as the investment committee. And their role is to recommend where the fund is going to invest, and depending on their mandate in question, they can take as well the investment decisions to invest into the different type of securities or other assets in question. And then there can be other delegations. For example, if it is you are launching a fund on, let's say, renewable energy, if the portfolio manager does not have all the expertise or the technical expertise for the renewable energy, then they can appoint either sub-investment managers or other specialized people. There will be a contractual agreement with them to define their remit, what they can do essentially, and then there will be those specialized people who will give consultation as well to the manager. But ultimately, the decision making of where to invest will be within the investment manager. And those are the 3 main elements. Then there are other parties involved, including the administrator, and the role of the administrator will be to accept the investors' money, so to increase the number of investors, or if there are investors wanting to exit the fund, to process such redemptions as well. Some of the funds will require a so-called custodian, and that is an additional level of control into the structure. Depending on the case in question, there can be a need as well to have a broker to act between the fund and the assets in question, to buy or sell the assets in question. And then there is as well the regulatory aspect of the fund, being the compliance officer, money laundering officer, risk, and audit as well. So this is like a company, but in addition to the normal company, there are some additional regulatory roles which will be included to give more transparency and control to the investors. The next area, so that is a fund, and a fund is usually used when the promoters want to attract equity, so not debt. In case of debt, although a fund can still be used, we usually use securitization. Securitization are a notch below the investment. The investment funds in terms of regulation, so they are less regulated than an investment fund, but they possess most of the characteristics of an investment fund. So they can be listed as well. There is a level of control as well within the structure. And they are usually used for issuing of debt. There are two main types. One type is a securitization which can be listed on a stock exchange, and when there is a listing process, the due diligence aspect and the transparency aspect is more rigorous. And there are as well the private placement ones, which are not listed on a stock exchange, and in some cases they are more economical to do, quicker to do, and the preference of our clients usually go for the private placement ones. The main parties involved in a securitization transaction, there is the originator, that is who is going to put the asset into the structure, and the originator can be only one, whereas in case of investment funds, the originator are usually various. The originator will, in this case, transfer the asset to the securitization cell. So they will transfer usually a project or any other type of assets. Then the securitization cell will, in case of a stock exchange, use the stock exchange to transform the asset into certificates, and those certificates are then issued to the public. In case where the transaction in question doesn't pass through a stock exchange, the process is much simpler because there is no stock exchange involved. The concept remains the same. So the transfer from the owner of the asset, from the originator to the cell will issue the certificates, it will collect the money will come back into the cell, and the cell will then pass the money, part of it, to the originator. And the remaining part will be kept there to be, for example, to act as the interest of the asset. So those are the main differences between securitization and investment funds. So the main takeaway from this presentation is that usually investment funds are for equity side. So when you want to attract equity investors, securitization, on the other hand, are usually used for debt financing. These are simple structures. Some of them can be much more complicated than they are shown here, but we want to keep things simple because the concept remains what we are explaining here. Christoph, shall I pass it to you as well to conclude the presentation now?
Thank you, Mario. So to wrap up quickly, here is what we've seen. So it's going to be difficult for poor credit rating borrowers to finance projects at 100% without any equity investments, beside government subsidies and charity. We have people asking us to help them raise money, and they come with nothing. They have no assets, they have no cash, and they don't want to pay anything up front. Well, the reality is that it's very difficult, to fund those projects, right? And there is a very simple reason for that. If it were doable, we would do it for our own sake. Indeed, what someone who's found the holy grail of generating money out of nothing would be sharing his procedure with third parties. Leverage can be obtained through financial instruments to enhance credit rating. Equity can be raised through regulated funds to open access to a different pool of investors. This is something to think about. If you have non-liquid assets like land, real estate, commodities, assets in the ground, art, you need to consider securitization. right? It's something that typically people don't think about, but it's a good alternative to monetize the non-liquid assets. Finally, I would say the best way, to address fundraising is usually to combine several sources and methods of funding to maximize the chances of success. So you don't want to discard the traditional sources of funding that we mentioned earlier. For example, if you're looking for the 10 million, and you need to raise the first tranche of $700,000 to cover the leasing cost of an SBLC, that first tranche may come from friends and families or from a venture capital or somewhere else. So the idea here is that you want to slice your fundraising process into tranches. Each tranche will bear a different risk, and you will need for each risk to address a different investor profile. It's something that, I come from a consulting background, and it always struck me to see that investors are extremely focused. Equity investors and debt investors are completely different animals. And from the fundraiser, they just want money. But in reality, for an equity investor and a debt investor, their procedure and their mindset is completely different. And they really make a difference between these two types of investments. It's all about aligning the investor's risk profile to the transaction's risk. So, Ron, I don't know if we've had some questions from the audience.
Okay, sure. I can go ahead and ask for the question. So thank you for that very informative presentation. Now it's time to open the floor for questions from our audience. Please feel free to type in questions in the Q&A or chat box. While we are waiting for the question, I just want to make a few announcements. ITC would like to offer free membership for those audience right now who are not yet a member of International Trade Council. So please feel free to reach out to me. And this webinar is recorded and it will be uploaded to our YouTube channel. So if you would like to replay, please feel free to do so and subscribe to our YouTube channel. Also, we will be sending certificate of participation for this webinar. So just wait for that via email in the next 24 to 48 hours. So have some question here. I'm not sure if this is a question. Maybe it's just a clarification. It was actually posted during the presentation of Mario. He is asking about asset funding.
Yes, so when you say asset funding, because it can take various forms as well. So is it my understanding that you are referring to an asset placed into a fund and then have it into the fund to generate income? What do you mean by asset funding?
So Sean, can you please elaborate your question? This one is question for Christoph. One second. What are non-liquid assets?
Okay, the non-liquid assets are typically non-cash and non-short-term securities. It could be real estate, could be commodities, gold, diamonds. It can be assets in the ground, it can be land, it can be parks. We had some funds, who are looking to monetize their collection of artworks. So what we do is we take those artworks that could be paintings or statues or anything that is related to art. We bring an insurance wrap around those non-liquid assets to have a financial instruments that we can use as a collateral. And then once we have the financial wrap, we can use it, to generate some sort of loan against those non-liquid assets. So, yeah, there's all sorts of non-liquid assets, and they have all sorts of lenders. Some of them will be looking at, more commodities. Gold is kind of in between because although it should be a non-liquid asset, it is so liquid that some investor would consider this as being a liquid asset.
All right, thank you. And next question is for Mario. How does how does it cost to establish a PIF in Malta?
Okay, so in case of PIF, there are various options which can be taken as well. For example, there are investment funds platform, and that will allow for lower cost to set up. And there are as well those who opt to have their own structure. Just to give an indication, it all depends on the underlying assets, but as an indication, if setting up a completely new structure, it will cost around 25,000 euro setup cost. If it is within a platform, for example, Christoph and myself have a platform in Malta, the cost will be more or less one half of 25,000. So you are speaking of around 12 to 15,000.
All right, thank you. Going back to the first question a while ago, Sushant mentioned and clarified that it's equity-based asset funding.
Again, I'm not understanding the question. So as equity-based asset funding, so if you are referring to funding of an asset through an equity, it can take the form of a securitization structure. So securitization, although it can be, or it is usually used for debt financing, it can be as well used for equity financing. So you put the asset into this cell, and then this cell will issue certificates which are subscribed by equity shareholders. Or it can take as well the form of an investment fund, whereby the investment fund will collect the investments from investors, usually that is the first step, and then the fund will start allocating the subscribed money into the different type of assets. So for example, if you have an liquid assets, which Christoph was making reference to them, and the owner of that asset wants to get something out of it, the asset can be placed into a structure. For example, you have bullions of gold, or you have a precious metal, or you have a high valued painting. Those assets can be placed into the structure, and then the structure will issue units or securitization assets to be sold to the public. So that is a way how to convert an illiquid asset into liquid cash. And then with the cash, the promoters can invest into other assets. Not sure whether I have answered the question there.
Okay, thank you. I don't see any other questions here. So before we conclude the webinar, I would like to ask Christoph or Mario if you have any other information you would like to share before we end the webinar.
Yeah, I wanted to expand a little bit on Mario's response regarding the cost of establishing a PIF in Malta.
Okay.
We need to distinguish between the cost of establishing from an administrative standpoint, and then the cost of actually raising the money into the fund. Raising the money into the fund will depend chiefly on the performance of the fund. If you want to set up a fund, you need to design the returns to the potential investor to make it attractive. If the fund is not attractive, then it's going to be difficult basically to raise money into the fund. So one of the solutions that we are offering is actually to team up with owners of assets, and instead of to be the anchor investors into the fund. So for example, let's imagine that you own several hotels, right? And you want to raise further capital to invest into additional hotels. One way would be to value the hotels that you own, transfer the ownership of the hotels into the fund, and then you create a fund which is not an empty fund. It's a fund that already has got hotels under management. And then when you go to raise additional funding, instead of having a newly created fund, I mean, you can claim that the fund is already operating because you already have the hotels right under management, and you can also use the past performance of the hotels to forecast the future performance. So this way, when you start, raising funding, instead of starting from an empty structure, an empty shell, you're starting with a fund which is already kind of mature, and this increases dramatically your chances of actually raising additional funds. Right. So I wanted to mention that because this is a clever way of actually starting funds.
Sure. Christoph, we have one question here. How would you do a sovereign guarantee? And if you offer a sovereign guarantee, what are your options to monetize?
Okay, so the sovereign guarantee is typically offered by a government, and it's backed by the government. So a sovereign guarantee works like a corporate guarantee, but instead of being backed by the corporate, it's the government which is going to guarantee the repayment of that sovereign guarantee. So the issue that typically you have when you issue a sovereign guarantee is that if the sovereign guarantee is issued by a poorly rated country, like a country in emerging markets, you will get a very low rating on your sovereign bond or your sovereign guarantee. And if you try to sell that bond with a low credit rating, we're talking about junk bonds there that don't reach the investment grade rating, there is very little market, and there will be very few investors willing to acquire those bonds. So the idea to still be able, to issue a sovereign guarantee and have buyers for the sovereign guarantees is to do credit enhancement. To do credit enhancement, you need to bring additional collaterals to your sovereign bonds to increase the credit rating of the sovereign bond. So, for example, we had a deal with a Indonesian bond, and to get this Indonesian bond to an investment grade rating, you need to team up with a fund. The fund will add additional resources in case of default. You will get an insurance on the default of the bond, and that will increase the trustworthiness of the bond, because in case of default from the country, then the insurance company will cover the risk. Some insurance companies like Aon have A rating, so there's a pretty good rating, and so this is, I don't know if I've answered the question, but this is typically the best option you have. If the country is a good country with a good credit rating, there is no major issue. You just go to any securitization house, and they will issue you the bond, and you will have a market, to sell it. The US, managed to sell their bonds, even though they should not have, such a good credit rating, because the level of debt is very high, but it's still working. I don't know if I've answered the question.
Usually, Christoph, sovereign guarantees are not issued to be monetized. They are issued to offer additional guarantees to whoever is going to buy the asset, so that they can trust more the investment in question. Let's say there is a government, and the government has issued a tender for an infrastructural project. The banks want additional guarantees in addition to what the project can offer, and they ask for the government to back it up by a guarantee from the government. So if everything fails and the project goes bust, then the government of the country in question will guarantee the success of the financing. So usually that is the main purpose of a bank, not a bank, a sovereign guarantee, not to be monetized.
Right. Antonio has a follow-up question here. When you did the Indonesia, was it a local government guarantee?
Yes.
Okay. All right. So I don't see any more questions here, but someone is asking for your contact information. If anyone, guys, can type in their email address on the chat box, or or if you would like to share your contact information, so if they would like to reach out to you directly.
Yeah, let me. Here we have. Here
Okay.
we have a generic contact information. I will put, I mean, the our email or respective emails into the address there. Address.
All right. So please feel free to type get or copy the email addresses of the speakers and the general inquiries email address if you would like to reach out to them directly.
Yeah, Maria, did I get it right? I hope.
All right. So I think we can conclude the webinar. I would like to ask for the final words from our speakers before we end the webinar. Mario?
Ron, thanks for organizing everything. It was a good presentation as well. Hope that it was useful as well to the audience. And we are available, both Christoph and myself, to answer further questions, or if you want to have a further call with us to discuss specific topic, more than happy to join into a call.
Thank you, Christoph.
Yeah, thank you, Ram, for organizing all this. My final insight in there is that every project is different, and we need to go into the nitty gritty details of the structure, and every structure will command a different response. So here, I mean, we've tried, I mean, to give an helicopter view of what can be done. But in fact, in reality, each deal needs to be crafted. It's like a handcraft type of work, and even on the funds, each fund will have its own structure. Um, each each guarantee will have its own structure, its own terms, its own cost, and we need to have a good understanding of the entire project. We also need to make sure that the parties involved are compliant, because Philoscope is a regulated entity, and most of the financial instruments require regulation. So anyone who is interested in working with us, I mean, they need to be aware that we have to go through a stringent compliance process. And but we, as Mario said, I mean, we're here to help, and we will be happy, I mean, to receive all your requests.
All right. So thank you all for joining us today. It's been a truly engaging session filled with insightful discussions and valuable takeaways. As we draw this webinar to a close, I'd like to express our gratitude to our esteemed speakers, our attendees, and everyone behind the scenes who made this webinar possible. Remember that the conversation doesn't end here. Stay connected with us through our social media channels and keep the dialogue going. Until next time, stay safe, stay inspired, and keep striving for excellence. Goodbye, and thank you once again for being part of today's webinar. You all have a wonderful day. Thank you, Mario and Christoph.
Thank you.
Thank you. Bye bye.